what is the maintenance cost gone into on each day, what is the consumption of prawn per cover. So almost every data is available to our restaurant team to analyze and then take a business call so that they can generate the returns that they needs to do. A very well-defined store opening process. Kushal leads this venture for us. We have opened approximately 70 outlets over the last 3 years following this process, and will continue to do so in future. Very strong on digital front. Uh, Approximately 2 years back, we revamped our app, and we have now approximately 2.2 million app downloads. And like I mentioned, we get a large part of our booking through reservation. Out of that booking, almost 48% of our business of our reservation comes through our own app and website, and the balance comes from our call center and some from aggregators. And we're increasingly seeing that the share of business coming from our own app and website is growing larger. We also launched a Barbeque Nation loyalty program. We named it Smiles, wherein we give back 5% of the bill value as loyalty points to our guests. We launched this in January 2020, and despite large period of last year getting impacted because of COVID, by December we had almost 10% of the entire transactions having a Smiles point redemption in our company. We also added a delivery feature in our app almost 3 months back, and increasingly we are seeing our business happening from own portals going higher. Very well experienced board. We have 9 members, out of which we have 3 promoter directors. Qayyum is the managing director. Other 2 promoter family members are Mr. Rauf Dhanani and Mr. Sujita Dhanani. We have 3 independent directors, Mr. Unni, Mr. Abhay Chaudhary, and Mr. Natarajan. We have 2 investor nominees, mainly Tarun from CX, who has been with us for long, and Mr. Devanjit Singh from Exponential. And I'm on the board as CEO and whole-time director. Very young and passionate management teams. You saw 3 of us, Amit, Kushal, and myself. Apart from that, we have good and very passionate business heads in all departments. Gulshan, our Chief People Officer, worked extensively with HCL Technologies, and his last assignment was with Oyo Rooms. Ahmad, our CTO, long timer with us, understands the business problems extremely well, and can convert and find a very tech-driven process and simple solution for the problems. Mansoor again has been with us for long, and earlier as a consultant, now full-time. Understands the project dynamics extremely well and ensures that there is no time and cost overrun on this. Again, Nagmani is a compliance officer, been with us for almost 7 years now. A very people-focused organization. We also got 7th rank in Great Place to Work survey done by Economic Times in collaboration with Great Place to Work in 2020. In terms of our operating our financial numbers, our revenue grew at a CAGR of 20% over the last 3 years. In FY17, we were broadly doing a top line of 500 crores, which increased to 850 crores in FY20. Subsequently, during COVID, the numbers have been low. In terms of our reported EBITDA margins, we have done approximately 24% margins at an EBITDA level. This number is post-Ind AS. To arrive at a number pre-Ind AS, broadly, 10% is the rental cost, which should be removed. FY19, FY20, the margins were approximately 20%. FY19 got impacted because of the impact of international business, which had some losses. It subsequently recovered in FY20, but in FY20, our margins declined because of some losses in the month of March 2020. So shifting gears to life post-COVID, things have obviously been extremely challenging for us, given that we were part of the core dine-in business. But as a team, we have reacted to this very well. And post-COVID, my personal view is that the business has emerged stronger than what it was before. During COVID, we focused on the following things. First and foremost, we ensured that as and when the supply side restrictions are eased off, we went ahead and reopened most of our outlets. By December 2020, we had opened 97% of our outlet network. Did extensive work on costs. So this includes both temporary rental reliefs in some cases to more structural changes in the way we operate our business at the store level, and also reduction in cost at the back end level. uh, launched a campaign called No Compromise Dining, which showcased all the safety protocols for our guests. Overall, we've also seen that the business has recovered month on month, and I'll show you a slide on that. More importantly, also strengthened our delivery business. We used to have a delivery business pre-COVID, which was small. The share of that business was approximately 3% or so in our overall business, which increased to approximately 15% by November 2018. Also, the liquidity was tight with the losses in the first half. We were successful in raising money. We raised 150 crores from two marquee investors, Jubilant Foodwork and Exponentia, and ensured that the health of the business is extremely strong. This is how we reopened our outlet. In the month of April and May, we only have few outlets opening in international markets. In June, in India, the government allowed restaurants to reopen in some states. So we opened 73 outlets, which then moved to around 123 by September end. And by December 2020, we had 159 outlets operational in the country. In terms of our sales recovery, the impact, we started seeing the impact right from March 2020 itself. April and May were extremely bad. We only had very marginal business coming from delivery. By June, when some restaurants started up, we did 10% of our sales as we did in the previous year of June, and slowly and steadily we saw this improvement. So from June month of 10% recovery, we moved to 56% recovery in September 2020, and by November 2020 we have achieved 84% of last year's November numbers. And this was supported both by delivery and dining. On delivery front, like I said, did extremely well. Last year, our cumulative business was only 26 crore. This year, in the first 8 months, we have done 38 crores. Started very slow in quarter 1 and quarter 2, but by November, we had reached to almost a run rate of 9 crores of monthly business coming from our delivery. On other metrics, which is what we track, which is average daily sales per restaurant per day, that number was around 5,300 rupees in FY20, which went up to around 18,600, almost 3.5x growth by November 2020. So going forward, want to continue to do the business the way we were. We want to preserve our guest and team focused culture. We want to focus on expansion in India. Also focus on our same store sales growth. Now we have additional lever coming from delivery business, which is an extreme focus area for us. We also believe that the market is very large and ripe for us to take advantage of this segment. We'll also selectively grow our international franchisee business, and if some partnerships make sense, we'll evaluate it. But overall, I think the key focus, if my top 3 focus would be to grow the Barbeque Nation outlets in India, to increase delivery, and also grow Toscano outlets in India. So that's it from my side. Happy to take questions from you.
Thank you, Mr. Agarwal, for taking us through the presentation. The report by Technopack states Barbeque Nation as one of the leading casual dining chains in terms of outlets, and casual dining represents the second largest share in the chain food services market after QSR, and as Mr. Invar has also stated, is expected to grow at a CAGR of 18%. Given the organization's business model revolving around the customer needs, one can say that the brand is in a good position to gather more momentum. We hope the attendees have captured enough and more understanding of Barbeque Nation's business model, its financials and food service offerings. Before the floor is open for participants to ask their questions, I would like to reiterate to type your name and organization details in the Q&A chat box for the moderator to take note and address your query. Note, in the interest of time, we will be restricting to 20 to 25 questions only, and repetitive questions will be skipped. Sir, what is the fundraise, and where is the utilization of the net proceeds going to happen?
Amit, you want to take that?
Oh. So total is around 180 crores in the primary which we are trying to raise, and of which around 75 crores would go towards the debt repayment, 55 crores for the capex, and remaining for the general corporate purpose.
So you've got 143 crores of debt on your books. Is this related to bank borrowings, and what is your post-issue debt going to be?
So yes, 143 crores entirely is the bank borrowings. So after which we will pay 75 crores, you minus that, and that would be the bank borrowings which you would have.
Okay, sir. Hospitality as a sector continues to, face business continuity issues during this pandemic period. Could you explain in detail on what has the net impact been of COVID on barbecue's business operations, and what have you done to come out of it? Are you seeing lower footfall when it comes to your dine-ins, or have they increased, or are showing a increase in trend? And what kind of activities have you done with respect to their safety? For example, your no compromise dining mandate that you continue with.
Right. So yes, no doubt, hospitality sector has been one of the most impacted one during COVID, and we also got impacted. Our quarter 1 and quarter 2 were very tough period for us. But I think what happened also in the industry is that because of pandemic, as per various reports, between and media reports, between 20 to 40% of restaurants had been shut, which also means that the players who have survived, for them, the market opportunity is also large. What we have done is following 5 things. First and foremost, when pandemic hit us, we ensured that we relook at our cost structures in detail, and we did that very extensively. Some of these measures were temporary, wherein you got temporary reliefs from your landlord partners, and some of these were permanent, which is some of the costs which were in the business no longer required, and you can remove that, right? So that was a big thing that we did. Second is, we kept reopening our outlet. We have belief in our brand. We knew that once we reopen, and because of the efforts that we took on the no compromise dining and the sanitation protocol, and the safety measures that we have taken, the customers will come, and that did happen. Slowly and steadily, month on month, we have seen our business improving, and reached to a point of 84% of sales as compared to last year's number by November 2020, right? Third, we focused on the delivery business. Like I said, pre-COVID, our delivery business was only 3%, and we innovated a new product called Barbeque in a Box, and that has done very well. And by November, almost 15% of our business came from delivery. And this is a new channel which in some manner COVID has thrown to us. Now, as things will go back to normal. Now, I don't know when that will happen, whether it happens in 2 quarters, whether it happens in 4 quarters. But the dining business will come back at a point of time. And when that comes back, on top of that, we'll also have a sustainable and scalable and scaled up delivery business. Like I said, by November, we have done 9 crores of business from delivery, which is almost 15%, and an incremental business of, on an annual run rate basis, close to 110 odd crores without putting in any capex there. That's the strength of the franchisee that we could leverage. Also, most importantly, raise capital at right time. We were not fussy about dilution, about valuation, but important thing is that you raise money when it is required and ensure that the health of the business is very strong. And that's what we did. And more importantly, we partnered with very credible player like Jubilant, who can also potentially support us on multiple things going forward. So that's what we did during COVID time.
Sir, could you give us a breakup of your historical and current breakup of your dining revenue and home delivery revenue?
So pre-COVID FY20, our dine-in business was 97% and home delivery business was 3%. This number in November 2020 was 85% coming from dine-in and 15% coming from delivery.
Sir, what is your split between your own app and third-party app ordering when it comes to online deliveries?
So that number, we have not disclosed in our offer document, and also our own app was very new. We launched it in November 2020 itself, and the only thing that I can mention is by every month we are seeing some improvement in the share of business coming from our own app.
Sir, how many users do you currently have on your app?
We have 2.2 million downloads on the app.
Okay, sir. There's a question which asks that how many of international stores are operated by the company and how many are franchised? what is the capital employed in these and sales and PBT numbers when it comes from international operations during FY 18, 19, 20? I'll subsequently ask another question once you're answering this.
Yeah, so in international business, we have 6 outlets now. All these 6 outlets are currently owned by us. It is not franchised. Overall, in the company, we have invested close to over last 4.5 years, 110 odd stores. We had some ups and downs in our international business. Initially, when we launched our first outlet in FY17, it did very well. Our second outlet also did very well, and that's when we overexpanded in that market maybe. So FY19 was not a great year for us in international business, but we had to shut down 2 outlets, and we also got out of leases of the 2 outlets. And what also happened was, we realized that maybe we had moved faster than what was required, and we quickly rolled back and focused on these 6 outlets that we had. And by FY20, which was the international business was making losses in FY19, turned profitable by FY20. In terms of sales, FY20 broadly we were doing around 45 odd crores of top line, and PBT, actually EBITDA level number that I remember currently is I think flat, a break even. What we'll do, Lalit, is we'll send those numbers or maybe refer to DRHP for those numbers. I don't remember that often right now.
No thing, sir, no problem. Given as you stated that the international market did pick up as you mentioned, when do you think these current stores where you are, the six stores that you have, when will they achieve economies of scale?
So these 6 are doing well. They're now profitable. None of the outlets lose money as of now. Some do very well, and some are almost early digits, single digit EBITDA margins. We have been very cautious in that market, and we have not invested in that market in terms of opening new outlets over the last 2 years. I don't think we want to plan to open new outlets by spending capital, but having been in those markets for the last 4 years, I think the learning has been immense. We understand the consumer, we understand the local laws, we understand the construction dynamics in that market, and that's very valuable. So at right time, maybe we'll convert our existing ones to franchisee, or maybe go and do franchising in those markets. But I'm not in a hurry. We will just wait and watch, and at right time we'll sort of take a call of how to expand that.
So no capex focus in the international markets as of now, because in your document net proceeds also shows that you're going to expand in the number of stores. In FY22 about 20 stores, in FY23 about 6 stores. So that will be focused only in India, is what you're saying.
Yes, nothing in international market. So this money will not go to international market.
Also, sir, these 20 stores that you will look at opening in FY22, will they be in newer locations or in locations where you have already existingly, gained a strong?
Yeah. So Kushal, do you want to take that? Kushal heads BD for us.
Yeah. So our presence would typically be again a mix that we have already had. We had almost 70% stores in our metro and tier 1 markets, and 30% in tier 2, tier 3 markets. We'll continue expanding in the regions that we are already there, and some percentage of our expansion will also go into entering new cities, new places, which we feel have potential to grow over a period of the next 3 to 4 years.
So do you feel scaling up in tier 2 and tier 3 cities, is going to be challenging? Just adding to, the question on the expansion as I spoke earlier.
Mm-hmm. So the expansion in tier 2, tier 3 is with a very clear strategy. These markets, eventually, it's important that you create your brand presence there where the market keeps growing. And we have a lot of examples of our places where we had grown, where we had entered 4 years, 5 years back. And now we have went ahead and opened second and the third store in these cities. So these cities with one store slowly starts adopting to your brand. They know you well, and as you see that the purchasing power of the public and your acceptability keeps increasing, you get the opportunity to further expansion. These will eventually grow into clusters of 4 and 5 outlets in those cities as they are growing. So it's important that we keep entering into these new growing cities as well.
So given the point you made on the purchasing power between tier 1, 2, 3 cities, what is the average bill size you guys are, seeing? And what is the price differential even when it comes to, your covers?
So the prices in tier 2, tier 3 cities might be at around 650 rupees, and in our metro market might go up to almost 900 rupees. So the price difference can be of around 200 to 50 rupees between these markets.
Okay, there's a question which asks that, can you throw some light on the unit economics? How much capex is needed to open a restaurant on an average? How long does it take to break even at a restaurant level? And what are the margins, in a steady state for mature restaurants? Again, on an average basis.
Okay, so I'll give you some historical data, and while we have not mentioned the entire unit economics in our DRHP, I will just try and take these numbers as much as possible from our source. So we usually spend, including every other allocation of cost, some of the softer costs which cannot be streamlined in the document, around 2.5 to 2.7 crores per outlet. Our store break even happens. Typically, it ranges between 2 months to 4 months, depending on which location these are. And historically, we have seen that as these stores mature, you tend to move towards revenues of approximately 7 crores every outlet for the full year. So because of the impact of newer outlets, the average revenue per store that you'll see is around 6 odd crores. Well, this is the pure play, numbers without having impact of any COVID or other things. Typically, our gross margins are around 65 to 66%. Our rental numbers at maturity would be approximately 10% on average. Our employee cost, and when we calculate employee cost, this is every cost that goes into, including employee food cost, the uniform, the gratuity provisions, multiple things, is approximately 20 odd percentage. And all other costs put together would be around 10-12%. So at maturity, these restaurants will do around 23% store level margins.
Okay, sir. A question, for your, view. Do you think the concept of over-the-table barbecue is still a fancy and still a novelty, or do you feel that it's lost its charm, given the other competitors who are coming in this space? Why do you think people come back to your restaurant?
No, so no doubt. Once we launched our first one in Bombay, it was novelty and people were talking about it. And then we ourselves have opened a lot of them, and a lot of competition have copied it. So the concept is no longer a novelty. It has, in fact, we have gone much ahead from that and redefined a category itself. Now, if you look at various industry reports, people talk about burger chains, they talk about pizza chains, and they talk about barbecue concepts. Right, that's the power of the brand that we have been able to sort of shift in this industry. I think yes, there are a lot of competition who has copied our concept, but what's very important is that so there are 2 points to it. One is I believe that the market is large enough and multiple players can be in this market. The other point, very important, is that that what we provide and what we continue to provide very well over the last so many years, which is value for money, service, and experience, and these three mixed together along with the guest focus is I would say the key differentiating factor. So you might copy the concept, but it's not very easy to copy the software aspect of it, which has been built at such a large scale in this company. Even if some people copy it, I think market is very large. If you look at the Indian food services market, the Indian cuisine market is the largest. We are among the very few organized large player in Indian cuisine. And the other way to look at it is that if for example, a burger category, which is not the core food of this country, can have 3 scaled up business with $100 million sales plus, I think Indian cuisine can definitely have more than that, right? So I personally am not worried about competition and market so much. I think there's lots to be done, and there's a lot of shift happening from from unorganized to organized in this country, like we're also seeing in multiple other retail or consumer industries in this country.
So there's a question which asks that when you're going to start making profits.
We always believed that we were doing okay in terms of our margins. Our EBITDA margins were very strong. We tend to believe that. Yes, the depreciation number is very high in this, in this company. Also, because of the fact that on the base of say 147 outlets in India in standalone business, we added almost 70 outlets over last 3 years. So some of these outlets will mature over a period of time, and the depreciation number is very high in that. We also had some debt which got built up both from our India expansion, our international business, and also our some of the acquisitions that we did. Now with money that we have already raised in the pre-IPO round, we have paid off large part of this. So the debt has come down from around 230 odd crores to around 150 odd crores, as Amit mentioned. We'll also use around 75 crores to pay debt from the IPO proceeds. And with the cash that we will have, we will be net debt positive. Yes, some debt will also be used towards some cash that we raise from the market will also be used towards expansion. But we also generate very high operating cash every year from our core business. Restaurant also is a negative working capital business, so the operating cash is very good. So if you add depreciation to our PAT and as the interest drag or the finance cost drags goes away, my belief is that in the same EBITDA margins, the difference between EBITDA margin and your PAT will further shrink.
So you recently invested into a new line of cuisine on the Italian side with Toscano. How much does that contribute to your revenues as on date?
So it does around 6% of our business.
Okay. And could you also, highlight of the investment you guys exited, with Johnny Rockets in FY18? What went wrong there?
Right. So it was a different concept. We wanted to sort of do, more of an American dining chain, again focused on value. Also wanted to customize the menu to Indian palate. But unfortunately, post entering into that partnership, I think the way the brand owner was looking at this partnership and the way we were looking at this partnership were different. We already realized that maybe this is not the way it has to be built. We as a nation also is very return focused, and if things were not being changed or customized to Indian consumer taste, we were not willing to sort of take it forward. And I think the best way that we found was to part ways. We had invested a very small amount in that, and including some operating losses and some capex that we had done, the amount was not large enough. And what we believed in is that instead of dragging the problem and make it really big and sort of infuse more money, it's better to get out of that and cut your losses that you had incurred. So we had no problem in accepting that this didn't work out, and we're also proud of the fact that we took the right call of exiting at right time, rather than keep investing and trying to prove the decision that we had made. So no, we don't have any of such issues.
So coming to the decision of getting into deliveries, barbecue in a box, could you just do a little bit of unboxing? Maybe show the box if you have it with you. To show as to what goes in it. And what price points is it, and what is the demand kind of been in that segment.
Yeah. So we have one box here. So this is the box that comes to you. This is barbecue in a box. So what you get is a full-fledged meal. This is how the structure is. Typically, you get 6 starters. So in each, there are 3 boxes. In each boxes, you get 2 starters each. You get 3 gravies here. You get biryani. You get raita with that, and you get a platter of 3 desserts. So overall, this box will have approximately 1.7 to 1.8 kgs of food, and good enough for around 2 or 3 people in the family, and priced very well. This we carried forward our value for money brand pillar. This is priced at around 750 to 850 rupees, depending on different markets and veg non-veg, and has done very well. We launched it in June 2020, and month on month we have seen a growth in the number of boxes sold every month.
So how has the movement been with UBQ, considering that's a la carte for Indian cuisine?
So that also has done well. Our UBQ business has also gained attraction post-COVID. Also, the focus has been very large on that. UBQ business, what moves very well is your biryanis, your smaller meal boxes. Those are more like small platters. They have also done well, but box business is larger than UBQ right now.
So from the maturity of a store perspective, there's a question which, asks that, from FY 17 to 20, number of outlets, has doubled from 80 odd to about 160, but revenues have gone up by 70% only from FY 17 to FY 20 to about 850 crores, as you stated. Could you please elaborate a reason for this?
So there are two reasons. One is your outlet network you will see immediately, and your maturity will go, or your sales will increase in restaurants. Sales by vintage. So your year one versus year two versus year three will be different. One is that. Secondly, if you remember the slide that I presented during the number of restaurants that we opened up in tier 2 and tier 3 market were higher in FY 17 and FY 18. And FY 19, FY 20, we had maintained that same 70-30 ratio that was now stabilized. And as Kushal mentioned, should continue in the same fashion. So that are the two reasons why you will see that the revenue number is only growing 70% and number of stores have grown at 100%.
So Barbeque has always followed a fixed, pricing concept. Particular to Barbeque in a box also, is this introductory pricing that you're offering to, the customers, or, is it going to see a sustained, pricing?
So, our pricing strategy is actually dynamic. If you know Barbeque Nation also, we have different prices at different times of the day, different parts of the week. And also it differs, by restaurants in the same city. So what we look at, what we focus on more is value for money. Some markets may find value for the box at 800 rupees, and some market might find value on 600 rupees, right? So we keep doing that. We need to provide what our customers want, and that's a key driving factor for us. And our future pricing strategy will only be governed by this particular factor in mind. If it means that we have to keep the price same for many years, we'll keep that. We'll keep working on our back end to ensure that we continue to deliver what the consumers need.
So how many years does it take for a store to become PBT positive? And could you highlight per store economics?
So we already covered that, Lalit, right?
Yes, sir. We'll move on. What are the EBITDA margins achieved by some of our mature restaurants, which are more than 3 years old?
So we have a data point in our DRHP wherein stores which are more than 2 years old in FY 20 have done approximately, I think 19% that we mentioned. This is despite the fact that our numbers got impacted because of losses in the month of March. Pre that, I think we used to do around 20% plus margins.
So there's a question which asks, what is the capex you incur per store, and for how long does it take for the store to break even or give you a payback?
So capex is, like I said, 2.5 to 2.7 crores. The break even happens pretty quickly, between 2 months to 4 months, and the payback period at the restaurant level, store level margins would be approximately, I guess, 3 odd years.
How are the margins in the delivery business relative to dine-in? What proportion of delivery sales Barbeque is getting, is looking to target in the long term?
So delivery is an incremental margin business for us. We do it from the same infrastructure that we have. So broadly, our food cost is pretty similar to what you see in the company level financials. There's marginal cost from from additional employees that you have, and then we pay very industry level rates to the aggregators. So the balance left would be very similar to what we do in our dine-in business. We don't have a target in mind that I want to share right now from our delivery business. Our endeavor would be to keep focusing on this and try and grow this average daily sales from our delivery business. And needless to say, we also focused on our dine-in business. It's something that we have done well for last 15 years, and we'll continue to do that. Just that how the market infrastructure had grown from the delivery side, we think we have a good business to build on that side too.
So Jubilant's investment of about 10.76%, how should one look at it? Is it strategic in nature, or is there some kind of synergy which is accruing, which may turn into a partnership?
So Jubilant today is only a pure play financial investment, right? And we are very proud to be associated with such a credible players like Jubilant. It's very young relationship also. It's hardly been 4 months, and we'll see how it evolves. There is actually no commitment from either side, and I think once things settle down, we're also done with our fundraising plans. We'll see what sort of partnership needs to be made. And while the investment is financial in nature, they're also not just a financial investor but also a very strong strategic player in the industry. And based on whichever areas might make sense, we'll evaluate it. But there is absolutely no commitment from either side to take this partnership in any manner.
So will your business model continue to remain the same, or you will try to look at a lesser capex, more of a setup, delivery only store kind of business?
So we have not done that right now, but if the market needs that, we have no problem in evaluating new things. We have always been trying new things. Some we have been successful with, some we have not been successful with. We have also, whenever we try new things, we also ensure that our core dine-in business is not compromised at all, and we don't plan to do that. We'll be focused on that too. And right now, I believe our delivery business itself is very young, right? And we have still not exhausted the potential of the existing outlets that we have. But as these grow, if we'll pilot with few of the other standalone delivery outlets only, and if it makes sense, we'll scale it up. I don't think that will be a challenge, but the focus right now would be to look at your core dine-in business and add delivery as a vertical in that.
So there's a question which asks that, isn't the ordering business of the business cannibalizing the novelty concept of in-store dining?
Oh, not at all. I don't see that. And if you look at the data that we've also provided in our document, month-on-month sales recovery post-COVID and month-on-month increase in our delivery business. Absolute numbers has been good. The core dine-in business is just not about food. It's about value, it's about service, it's about experience. And I don't think you can pack these into a box and send it to customers. When we look at our dine-in, our delivery business, what we're only saying is that the Indian cuisine market is very large in this country. And we have got very good infrastructure across this country of 147 outlets, from where you can provide good authentic product to your customers on Indian cuisine, right? And that's the reason why when I say that we are at run rate sale of 9 crore in the month of November, and run rate of 110 odd crores or whatever, that's because you have an infrastructure, right? And that's how we look at this. All we are saying is the market for Indian cuisine is large. People were ordering Indian food from some of the unorganized players, some of the regional players, and now we are coming up with an option for them to order Indian food in a more organized manner from a brand like Barbeque Nation.
Post-COVID, how are your rentals looking like? Could you throw some light on the rent to revenue ratio, what is the normalized rate of rent as a percentage of sales looking like to you?
So absolute numbers have come down because of some waivers and some, in some cases, also structural renegotiation of sites. On percentage number, it will look higher because your denominator is low. Because if you look at first 8 months data, you had losses in or lower sales in Q1 and Q2. But as business has been coming back, reviving. For example, in the month of November, when we reached to 84% of our sales, our rental numbers had been converging towards the normal that we used to have pre-COVID.
Could you throw some light on the digital ecosystem you have created, be it a CRS, be it your guest satisfaction index? Also, there is a question which asks that do you have any software to track orders from repeat customers or track the number of times a person visits the restaurant in a particular year?
Yeah, so we have all of those stuff and very well integrated. So one is our CRS, which is well integrated, and we get all the data from the customer. Like I said, we get large portion of our business from reservations, and that's why the data collection rate is very good in the company. And we also do various work on repeat customers, and that number is approximately 50% of repeat customers in our business. And apart from just the customer data, and also the second is the app property, right, which is growing very well. The new loyalty program that we have launched is doing fantastic. I think in 1 year, reaching to 10% number is very good. And now the delivery that you do from your own app. So the way we are seeing it is that as large portion of our business comes from reservation, and the share of app business is going higher on the reservation. Some of these customers are very happy with the loyalty points that we get, and they can redeem those loyalty points in our own app itself. So this is an ecosystem that is developing very well, and we have spent some good amount of money on building this up and focusing on this, and over a period of time, the returns will come out.
So what has your same store sales growth been in FY 18, 19 and 20?
So we have that number in our DRHP. It is approximately 7.5% in FY 18. I think around 5.5 in FY 19, and approximately -2 odd percentage in FY 20. FY 20 got obviously impacted because of the March month of COVID. If you adjust for that, we were doing okay.
Thank you, sir. Let's just have a few more questions come in, so we can ask the management. So there's a question which asks that who do you think are your key competitors in this market?
So the food services market, it all depends upon how you look at it. You can compete with anybody else who provides you food options, and this could be players like a pizza player or a burger player or any other cuisine player. We compete with almost every segment of these players in the trade area that we operate in. So I don't think we can define any one large player in this country with whom we compete very, very strongly.
So CX has been on your board for quite some time. Are they, how much are they offloading through the OFS? Are they planning to exit anytime soon?
They're offloading, I think 10% in the business, right, Kushal?
Yes, so they are offloading 10%. They are holding right now around 28% in the business. Post this, they will be holding around 16.5% in the company.
Okay. So what is your menu innovation strategy? How often do you change your menu options and in what ways?
So two things we do. One is we keep coming up with periodic food festivals. So that's when we focus on either the product, which is your menu, and some of the examples of food festivals would be, seafood festival, Muhammad Ali Road, Hakuna Matata, Delhi, charts of Delhi. So those things we keep doing across all our restaurants, and we keep coming up with some specific dishes which run for maybe a couple of months in various restaurants. But having said that, the core, which is the core starters, the grill concepts, the main course, almost 80% is same, and that's what the consumer come to us for.
So what period were your restaurants shut, and what was the anticipated revenue loss during that period?
So we were shut completely in India in April and May, and as various states permitted us to restart, we started to open up our outlet from June till October. Maharashtra was the last state to allow us to open, which we started in October. Anticipated revenue loss. Well, very difficult to give a number. I would say in November, we were at 84% of our business, out of which 15% was delivery. So if you remove that, the balance itself is your loss, right? Uh, from your dining business. Plus, there is growth which didn't happen. So it's very difficult to calculate that, Lalit.
So your EBITDA margins for mature stores, saw a downtrend since FY18. Any particular reason for this?
Right. So FY18 was the year when the industry also lost input tax credit. So that impact you would see in FY19 and FY20. You would see that the month of March is the period which dragged the entire EBITDA margin down, because we had losses in the month of March, which otherwise would have been profitable, right? So there's double drag because of this. One is the profit didn't come, and the second is loss happened and dragged the entire margins down. So I'm not worried about margins. These are all, in my view, explainable and more of external factors driven rather than internal factor driven.
Okay, sir. What would be the share of cuisine type to the top line? Could you give us a breakup of that?
So we only have a la carte, so all you can eat in our business. Our Toscano business, which Italian cuisine, does around 6% of our revenue, and the balance 94% come from core Barbeque Nation, which is barbecue food, all you can eat, largely North Indian cuisine.
So how does the company forecast on its raw material requirements? Have you faced any kind of shortages before? How do you deal with wastages?
So we are a very data-driven company. The insights platform that we have tracks on a daily basis how many covers happened, what is the consumption by item, and based on the future forecast of sales, which is then forecasted based on the historical trend, and whether there's some special event during the following fortnight which can shift the demand. This algorithm model comes out with the forecast of raw material.
Okay, sir. Coming to the last question, if there are any other pending questions, we will definitely reply back, to the attendees. But this is particularly, I'm sure, to be answered by the beer. It's on the valuation, sir. It asks that, to Jubilant, you recently 2 months back, gave a preferential allotment at about 252 rupees, and you're coming at a 500 rupee price right now. And in the past also, there have been pricing differentials to allotments that have been done. For example, Mr. Junjunwala invested at about 832 rupees. So, can you justify the current pricing right now? I suppose this can be answered by the banker.
Maybe I'll take this, Lalit, and thanks for asking this question. So I think the way pricing works in any other IPO, we followed that same concept. We showcased this business to over 80 plus investors across geographies. And some of the things that investors appreciated about this business include the core business model and the ability to scale across formats. Investors also like the quality of the management team and how agile and committed they are to this business, and how quickly they have been able to revive this business from an extremely difficult phase. The most important parameter which a lot of investors liked was how attractive the financial metrics could be once things normalize. In FY20, the company had delivered an EBITDA of 168 crore when UBQ and Barbeque in a Box were not even there. On a steady state business, this business can be extremely profitable. Based on these factors, a large number of investors from across geographies indicated their interest to participate in the anchor portion of the IPO. And believe me, the response has been overwhelming. This is how we eventually decided to come up with this price point. Just to clarify, I think since this question is often asked, all these investors who have indicated anchor interest are qualified institutional investors and are cognizant of the valuation at which rupees 150 crore was raised from Jubilant, Exponentia, and some other investors. That capital was required for survival of the business. And there was no visibility of the IPO then, and hence it was done at significantly lower valuation, since saving the business at that point of time was more important to management than anything else.
Right, Vivek, I just want to add one more point, and you very well put across the point of liquidity stretch that we had. And that was mostly driven by the fact that COVID had made a big dent in our profitability in Q1 and Q2. Also, if you remember, while the transaction happened in the month of January, these transactions take time to discuss and negotiate, right? And if you remember, in the month of November and December, globally the COVID cases were rising up again, right? There was a second wave, and if that would have hit us hard, thankfully it didn't hit us. At least it didn't do in the month of November, December. We could have been in really difficult spot, right? So as Vivek also mentioned, for the management and for the board and for the shareholders, the health of the business is paramount, and we don't mind compromising on some high dilution to ensure that the business is protected. And that was the whole and sole reason why management took that call. And today, I think in hindsight, I would say it was a good call to be have taken.
Thank you, Mr. Agarwal. Thank you, everyone, for showing interest in knowing more about the company, its leadership, and future potential. I would now like to call back Mr. Vivek Toshniwal on the screen to make the closing speech before we end today's webinar.
Sure. Thank you, everyone, for joining. This business was one of the worst affected businesses in the pandemic, but the way Rahul and team have resurrected this business shows how strong the management team is and their commitment for this business. As much as Rahul talked about the importance of guest satisfaction, I am sure they will have the same focus on shareholder satisfaction going forward. The anchor book is scheduled tomorrow, and the main book will open on 24th March and close on 26th March. We look forward to your participation and seek your support in ensuring that this story of Barbeque Nation Hospitality Limited is widely marketed to your clients and well-wishers. Thank you once again for taking time out to attend this session. And please do order Barbeque in a Box and try it out in case you have still not done that.
Thank you, Mr. Toshniwal. Esteemed audience, we've now come to the end of the webinar. We look forward to your participation and support on making this initial public offering a great success. Wishing you all a great day and keep safe.
Thank you, everyone.